Once again, my name's Jimmy Robinson. Welcome to Navigating the Dealership Buy-Sell Market. Hopefully you'll find this to be a very informative session. I'm going to turn it over to Jesse Stopnitsky, and he'll take it from here.
Thank you, Jimmy. Good morning, ladies and gentlemen. Thank you for joining us today. I am Jesse Stopnitsky, co-owner of Performance Brokerage Services. I am honored to be sharing the stage alongside my esteemed counterpart and your AICPA dealership chairman, Jimmy Robinson. Unfortunately, Jimmy and I are not as funny as Mike. We do not have this presentation loaded up with jokes. He seriously had me laughing out loud a few times over there, but we will do our best to make it informative and enjoyable for you all. Thank you sincerely to the AICPA for inviting us to speak. The AICPA is an exceptional organization and conference. We truly value the commitment to our dealer body and to our accounting professionals. And we also deeply appreciate the role that each of you play in your organizations and your contribution to our shared automotive industry. For many years, we've attended the dealership conference when it was back at Vegas, no comments. But I've seen many people stand on this side of the stage, and I'm immensely proud to be here with you all, sharing our perspectives, our unique insights, and hopefully we'll provide information that is relevant and valuable to you. Without further ado, today's session is titled Driving Value, Navigating the Dealership Buy-Sell Market. Our agenda is as follows. We'll begin with a brief introduction of the company. We'll take a look at the state of the retail market. We'll assess the current buy-sell market. We'll discuss valuations and identify emerging trends that are creating challenges and friction in today's transactions. At Performance Brokerage Services, we are a family company, founded by my father, actually. This is not my father, this is just a stock image from Shutterstock. 30 years ago, he had a vision to build a reputable M&A firm, governed by an unwavering commitment to honesty and integrity. Now with second-generation family ownership at the helm, these values run deep throughout our firm, and they are the foundation for our success. Our value statement is as follows. Befriend your client. Lead your client with your expertise. Put your client's interests ahead of your own. Under all circumstances, just do the right thing, and the business will follow. Our firm operates out of 13 offices across the United States and Canada, providing clients with national exposure and local representation and local market familiarity. Our team is comprised of M&A advisors, former dealers, 20 group moderators, manufacturer representatives, and CPAs, all who are committed to our company's value statement. As such, our exceptional team has helped us to become the highest volume dealership brokerage firm in North America. With over 900 dealerships sold, we are a trusted resource for helping dealers navigate the complex process of selling their businesses while protecting confidentiality, preserving the legacy, and maximizing the value. In 2025, we are pacing to sell over 97 dealerships, which would be a record-breaking year for our firm, and also speaks to the continued pace of buy-sell activity. With divisions dedicated to automotive, RV, marine, power sports, trucking, and equipment, clients benefit from national exposure to the largest and most qualified dealership groups across all dealership verticals. This is a trend that we've seen accelerate in recent years as dealers are looking for ways to de-risk their portfolios by diversifying and developing new verticals. I'm going to hand the microphone over to Jimmy to take a look at the state of the retail market.
All right. Thanks, Jesse. You've got the clicker.
You got
All right, we're going to do a little quick dive into the retail market. OEM market share. You know, I don't think many of you will find it surprising that the market share for Toyota and Honda and all those are unchanged. They continue to perform at a high level. General Motors is up 3.2% this year, which is a little bit of a surprise to me. No surprise at all that the Korean brands, Hyundai and Kia, which are some of our most requested brands, are up 1.4%. Probably no surprise to you as well either is who the decliners are in the market. Stellantis, Nissan, and Volkswagen are all having very tough times right now, with Nissan showing an $11 billion loss through the first 6 months of the year. Stellantis with their migration back to gas-powered vehicles and bringing back the Hemi, they're in a transition period that has been very tough, and Volkswagen just doesn't seem to have much direction whatsoever. So you also see that Tesla is down 6.6%. In August, there was a great acceleration into the EV market. It was up tremendously in August. Why was that? It's because the EV credits are running out. What's the EV market going to look like in the U.S. now that the EV credits have gone away? The czars, we all like to talk about it. Right now it's pacing 16.4 million units according to NADA. Still a great number, but is it sustainable? I think I looked, and the projected number for new car sales next year is projected to be between 15 million to a high of 16.2 million, depending on who you ask. So there's a decline. Well, what's driving that decline for projection next year? Well, there's a potential, the forecast is influenced by high prices of vehicles, which Michael talked about earlier, increased interest rates, and tariffs on some brands. All that's going to go into play. So, there is a potential for a decline. Some economists are saying once, some twice in interest rates over the next few months. That should help. It drives a little more factor in autos than it does in mortgages, but still, there's a decrease projected next year in the czar. Volume and affordability. Michael touched on this a little bit. When this was put out, the average retail selling price for 2024 was $47,652. On October 14th of this year, Kelley Blue Book put out that the average transaction price of a new vehicle in the United States is finally topped $50,000, coming in at $50,080. That's a 5% increase over 2024 and a 35% increase since 2019. That is significant. They also said that, what's driving this price? Well, what's consistently the number one vehicle in America that sold? It's that Ford F-150, and they're topping $65,000 now on average. So the price is not going to come back, unfortunately. And they also said that the $20,000 market for used cars is now officially extinct. You can't find them anymore.
Jimmy, if I may for a moment here, I think it'll be interesting to see how the impact of interest rate relief as well as the tariffs are going to impact new vehicle sales in 2026. So far, the manufacturers have absorbed the brunt of the tariff impact. That's likely to change when they roll out the 2026 vehicles. So it'll be interesting to pay attention to vehicle sales in 26.
Yes. And while we're talking about affordability or lack thereof in today's market for the average consumer, Edmunds put out on July 14th of this year, nearly 20% of new car loans now have a monthly payment exceeding $1,000 a month. We're not talking about the ultra luxuries anymore. We're talking about, the $50,000, $60,000 vehicle. More than 22% of borrowers opted for 84-month leases in the second quarter of 2025, representing an all-time high. So you got an 84-month lease, $1,000 payment, and these trends, along with high interest rates and lower down payments, they say resulted in a record high finance average of $42,388. So like we said, the prices are here to stay, unfortunately. The average vehicle age, look at that, new passenger cars, 14 and a half years people are keeping their cars these days. And light trucks, 11.9, where it averages out to 12.8 years. That's unheard of. When I was growing up, everybody was getting a new car every couple of years. Now people are holding on to them.
Jimmy, if I may, last time I'll interject, I promise. But this one had you and I scratching our heads a little bit, and I'd actually like to pose this to the audience for a moment if anybody here has any theories. You and I were trying to theorize about why the age gap between passenger cars and light vehicles accelerated during the pandemic, or what appears to be at the beginning of the pandemic. We came up with our own theories, of course, and we went to ask someone smarter than us. Somehow we ended up on ChatGPT, of course. But before I share with you all what AI had to offer, any theories? Really, no wrong answers. It's probably a combination of many things, but why the divergence? Why the acceleration of the age gap between passenger vehicles and light trucks since the pandemic? They stopped making cars. That's definitely one of the theories. If you're a Ford Focus loyalist and they discontinued your Ford Focus, perhaps you're not ready to switch to an F-150 when you've been driving sedans. Anything else?
The cars are, because they're lower priced, generally going to want to be owned by the households that are most economically challenged. I would guess that would have some effect.
There's no guesses and there's no wrong answers. That was one of the theories as well, that the affordability of these light trucks, for example, that have gone into the $80,000, $90,000 for a light truck, steps outside of the affordability by the households that are looking for family cars, sedans, passenger vehicles. Excellent theory. Any others? All the way in the back there, the gentleman in the far back.
My theory would be with the cars, people are working from home more, so those cars are sitting in their driveways while trucks are used for, construction and things like that. They're still on the road working every day.
Absolutely.
That's what AI had to say, actually, was exactly that. That while the age of the vehicle increased because people are driving less, working remote, not commuting, the difference is that light trucks had a commercial component to it that either required or allowed them to be replaced more frequently than passenger vehicles. And those three were actually the three that Jimmy and I were scratching our heads about and theorizing on. So credit to the man in the back with the nice jacket. All right, let's keep rolling.
Yep.
Thank you all for your participation there. We found it to be quite interesting.
And then the last slide, when it comes to the retail market right now, is day supply of inventory as of August of 2025. You'll see the national average is at 77 days. For the most part, those who are lower than that, it's no surprise. It is Lexus, it's Toyota, it's Honda, it's Subaru, some of your best brands right now. To the top, you shouldn't be surprised either. It's Stellantis, it's Volvo, it's Mitsubishi. So I think there's a direct correlation, obviously, with the performance of the franchise with their inventory management skills as well. So, just a quick update on the retail market. Jesse?
Thank you, Jimmy. All right, let's dive into the state of the buy-sell market. I'd like to begin by sharing with you all one of my favorite data points that I have come across in over 15 years as a buy-sell advisor. When we look at dealership ownership, 91% of the dealer principals own and operate 1 to 5 dealerships. It's safe to assume that that's the majority of the clients that we represent in this room. So despite the barrage of headlines in the automotive publications concerning publicly traded companies or those groups perhaps with over 25 dealerships, according to NADA, they represent less than 1% of dealership owners. Let's focus on the 99%. Further, in 2024, more than 50% of the dealerships retailed less than 500 new units. So as we continue through our presentation this morning, our emphasis will be on providing insight that is relevant to you, to your clients, to your organizations. When we evaluate the buy-sell market, we consider 2 indicators, values and levels of activity, and the 2 naturally influence each other. And in 2025, both valuations and levels of activity have softened. So let's explore some of the factors that are driving the current buy-sell market. Profits are finally establishing a new post-pandemic normal. And they've settled nicely and are in fact well above pre-pandemic levels. And of course, this has contributed to softening valuations. But this reduced pricing is actually stimulating activity and bringing new buyers or old buyers back to the market. Those buyers that have been expanding through the pandemic can continue to do so at lesser valuations. But those buyers who perhaps were conservative in recent years felt that the valuations and the pricings exceeded their comfort level, or perhaps first-time buyers have re-entered the market. Lastly, those selling dealers who rode the COVID wave all the way to shore, they built up a greater nest egg. they are now able to retire even at softer valuations. So as we continue to distance ourselves from the peak valuations and the peak profitability during COVID, the pricing gaps between buyers and sellers should continue to narrow, thus further driving and stimulating buy-sell activity. Now, despite the most recent rate relief and anticipated rate relief, interest rates for business loans, construction loans, acquisitions are still considerably more costly than before, and this debt service impacts the bottom line for any acquisition. It'll be factored into buyers' pro formas, factored into their valuations, and factored into the performance of the business. Every 4 years, every presidential election, we see a slowdown. The word uncertainty becomes a new buzzword in our industry, but there is still, in fact, uncertainty in the marketplace, in the economy, interest rates, tariffs. This administration, if anything, is unpredictable. In the ever-changing automotive retail landscape, we have uncertainty. We're always in uncharted territories. And as such, buyers are factoring this uncertainty into their considerations and into their valuations. With profits normalizing, some buyers have chosen to focus their attention internally to maximize performance and efficiencies, to resolve operational challenges with less of an appetite for external growth. Additionally, with the heightened valuations during COVID, then followed by normalizing profits, some buyers, in fact, overpaid for businesses, unable to get out of it what they put in. This has some buyers being more conservative, scars from their experiences over the last few years, and they're going to factor this into their valuations, and they're going to be more selective with the stores and the markets that they pursue. However, the basic principles of supply and demand reign supreme in the automotive industry. By the sheer nature of these high cash flowing franchise businesses, it's always a seller's market, and the current environment is no different. There is a limited supply of opportunities available for purchase, and buyers are cash flush, putting pressure on the marketplace. We also have the introduction of new buyers, new entrants into the marketplace in the form of alternative capital, which I understand is on the agenda for tomorrow, and I'm personally very much looking forward to that session. Let's explore some of the motivating factors that may encourage someone to buy or sell a dealership for groups and dealers of all sizes. You may ask yourself, why would a publicly traded company divest of a dealership? Their objective is to build their critical mass and increase the top line revenue. Why would they divest? Well, when publicly traded companies are evaluating opportunities and executing their growth objectives, as they're evaluating new opportunities for purchase, they may choose to or be forced to divest of a store that perhaps may be an underperformer, negatively impacting their scorecards, or they may be reaching the limit on their framework agreement with that brand. Additionally, as they've expanded their geographic footprint over the years, often acquiring large groups of stores, there may be stores in certain markets that no longer fit their long-term growth plans, their long-term objectives. And lastly, they are not immune to having those stores that you just can't quite figure out. In this case, we sold for Lithia their Nissan dealership in Carson, California, Southern California. For many years, Nissan struggled in Southern California with market share, as well as having a lot of turnover in the dealer body. And we sold it to Mass Automotive Group. Mass owns 4 contiguous and neighboring Nissan dealerships in Southern California and loves the brand. Naturally, the perfect buyer. Premier markets and premium brands are attracting national attention from buyers right now, and they're commanding premiums. The strong performance of these brands, especially in populous markets, offers access to top-tier talent and therefore allows for absentee ownership. We sold a group of luxury dealerships in the Seattle market to Fields Automotive Group. They're a 30-plus rooftop group with stores in the Midwest and the Southeast, but nothing west of Illinois, and they expanded out to Seattle for a group of luxury stores. Kevin Wepper, who owns a Toyota dealership and a Lexus dealership in Southern California, expanded as far east as Amherst, Ohio, to acquire Premier Toyota. And speaking as a Southern California native, we don't like the cold in Ohio, but they were willing to go out to Ohio for a Toyota opportunity. 20 years ago, it was mainly the publicly traded companies that would acquire another dealership group or a large platform. But in the last 15 years, in the pace of consolidation, we've seen a rise in the large regional groups. Compounded by high profits during COVID, we've been involved recently in numerous transactions of regional groups acquiring large local platforms. With the ease of scale and integration into their existing footprint, or at times, if only even to protect their flank from another competitor entering their market in a significant way. These regional groups have a unique motivation for acquiring these local platforms and tend to outbid the market. Sarchone Automotive Group was a 6-rooftop platform in Ohio that we sold to Ken Ganley. Ken Ganley Auto Group being a top 15 dealer in the country and the largest in the state of Ohio. With Flynn Automotive, it was a 4-rooftop group right on the border of eastern Ohio and western Pennsylvania. With number 1 Cochran being based out of Pittsburgh in western Pennsylvania, they were able to acquire and expand for the first time outside of Pennsylvania while staying in their geographic footprint. And even iconic stores like Worthington Ford in Long Beach, California, were looking to capitalize on the record-breaking valuations. Here we introduced them to the Norrie Shaver Group, who with only 15 dealerships, less than 15 dealerships, ranks in the top 15 nationally for new vehicle sales. They weren't going to miss out on the opportunity to acquire a high-volume and iconic Ford store in their backyard. Now, the data on this chart was annualized for 2025 using the transaction volume as of the end of Q3 2025. So it is not exact. It is intended for illustration purposes only, but it does in fact illustrate the current pace of activity. The industry's transaction volume in 2025 is down 30%. For the last few years, we presented on why the pandemic resulted in such high levels of activity, and I do not want to rehash that, but we have to touch on it briefly, because what is the relevance of a year-over-year comparison when we're working with anomalies? And that's exactly what COVID was. High profits resulted in higher valuations, of course. Buyers had cash burning a hole in their pockets, and they were looking to invest it and looking to capitalize on that unique profit environment. Dealers who may have been on the fence about selling made the decision earlier than planned. Even large groups like Jim Coons, for example, saw an opportunity to exit the market at peak valuations. And collectively, this resulted in record years of buy-sell activity. Now we have a different environment. But despite the headlines, these figures are still well above pre-pandemic levels. And as a buy-sell advisor, we are very pleased with the levels of activity. On the following slides, we take a look at transaction volume by state and by franchise. Now, while I personally find this data very fascinating, we're not going to spend much time on it. It is raw data. It is included in your handouts if you'd like to review at a later time. Looking at the transaction volume by state, it should be of no surprise to anyone in this room that those states with the highest dealership count naturally led the way by way of transaction volume as an absolute number, of course. But in the column furthest to the right, you can see the 2025 transaction volume as a percentage of the total dealership count in the state. Surprisingly, Indiana leading the way. That was in part due to a 9-rooftop platform that was sold in Indiana this year. Here we have a heat map that shows the number of transactions over the last 5 years based by state. Now, over the years, we've tried to extract data from this and find some motivating driving factors. We've pretty much come up empty-handed, with the exception of the fact that buyers typically look for warmer climates with year-round selling season, growing markets, states that have a business-friendly climate or are tax advantageous, and those states that don't have a right of first refusal or stronger state franchise laws. Looking at the transactions by franchise, similarly to the previous slide, those franchises with the largest dealer network, of course, are going to experience the highest volume of transactions by franchise. Though as an absolute number, the limited availability or supply of opportunities to acquire luxury dealerships or brands like Toyota, Honda, Subaru are historically far and fewer than that of domestics or secondary imports. And naturally, this is, of course, going to influence the demand for these franchises. An unfortunate takeaway, truly, Volkswagen, of the data that we track, we could only identify one Volkswagen dealership that transacted in 2025. Easy to do as we actually had sold it, but we are seeing many Volkswagen dealerships shut, not many. We are seeing some Volkswagen dealers shut their doors, unable to even find a purchaser. So hard times for the brand, and we certainly hope it finds its way back again. More appropriate, though, is to consider the number of transactions as it relates as a percentage to the franchise network. And typically the franchises are about 1.5% to 3% of a franchise network will transact annually. So for fun, we graph the 2025 transactions as a percentage, but we're working with small data. Land Rover, for example, which is leading the way, only transacted at 9 dealership sales last year, 4 of which were part of a platform sold to Sonic Automotive. So this is going to skew the data, of course. All right, enough with data. Let's jump into valuations. And I recognize I am preaching to the choir here with the following, but as you all know, one size does not fit all. Although lately we have seen some transactions where dealerships are transacting for their asset value only, these highly desired franchises command goodwill. It's the nature of a franchise business. And as such, this disqualifies the use of the asset-based approach in our industry. The next is the market value approach, which establishes the value by comparing it to other businesses that recently sold, as if all Toyota dealerships are the same, for example. But there's no MLS. There's no centralized data center of comparables. So as an industry, we've gravitated towards the concept of a multiple of earnings, where the multiple is dictated by the franchise. But the challenge with this approach is that it ignores a host of other intangibles that may influence the attractiveness to a purchaser. If only for one example, and I could list 100, let's start with one. If a Subaru dealership, for example, in the Pacific Northwest, where its market share is second only to Toyota, does it command the same multiple as a Subaru dealership in the Midwest? And if they're both in the Midwest and one is losing money, what do we multiply it by? So our preferred method is the earning value approach, where the value of the business lies in its ability to produce future income and future cash flow. And this requires a consideration of all tangible and intangible variables, with the strength or the multiple of the franchise being a single consideration. And this at the end of the day, though, we all know valuations are an art. It's not an exact science, and the value of any asset is what a buyer is willing to pay. We know that, but the value is truly determined by only a few key ingredients. Buyers and sellers' unique motivation for a transaction, buyers' pro forma earnings, and buyers' desired return on investment. And this is why every buyer places a different value on the same dealership. And the crux of building a pro forma or forecasting in recent years has been how to account for those stubborn COVID earnings, stubborn being a good thing in this case. We've had to determine which areas of the business underwent systemic and sustainable growth, and which areas were solely attributed to COVID. And this required taking a look under the hood and studying the business from a departmental level, not just looking at past earnings. But I am pleased to report that over the last 18 months, we seem to have settled at a new normal. This should offer greater clarity for forecasting. New vehicle gross profit by way of gross profit per vehicle retailed and margin have exhibited tremendous consistency the last 6 quarters or 18 months. And they're up 73% and 32% since before the pandemic. Additionally, with the loosening of the EV mandates just last month, essentially, many manufacturers are shifting their focus and their production allocation back to high-margin vehicles like light trucks and SUVs. This is going to have a further positive impact on the new vehicle department. Used vehicles, of course, saw an uptick during the pandemic due to the production limitation of new vehicles and the increased pricing of new vehicles. Though as we see, the PVR and the margin has stabilized, making it more predictable. F&I has settled as well, and it's 45% higher than 2019. In fixed operations, the appropriate metric to track is the year-over-year growth. Rather than margin or gross profit, it's the year-over-year growth. Well, this was incredibly difficult to forecast during the pandemic. In 2020, we had government shutdowns. In 21 and 22, we had production constraints for parts that were impacting the service business. In 24, we had a CDK outage that shut down thousands of dealerships nationwide. We still don't have as much clarity as I would like for us to have. But historically, before the pandemic, the fixed operations gross profit was growing at approximately 3 to 5% per year. So hopefully we can use 5% as a benchmark going forward. When we look at adjusted EBITDA, we recast the track record for buyer's analysis. We account for one-time and discretionary expenses, such as construction or remodeling, asset or equipment purchases, especially with many dealers taking advantage of the Section 179 allowance, one-time lawsuits and legal settlements, travel and entertainment, which this picture looks a heck of a lot better than what I saw the weather outside today. No earnings analysis would be complete without adjusting for fair market value rent. But ultimately, buyers are buying their projections. Buyers will use the track record to look at revenue and margins, trends and patterns. They'll study the expense structure, but the objective is to build a pro forma for their earnings and to back themselves into an offer that satisfies their desired return on investment. And of course, the more stable and consistent the track record, the more confidence that's going to offer the buyer in their pro forma, in the sustainability of the earnings. And when we have confidence and lower risk, we can therefore allow for a lower return on investment, i.e. kicking the values up. And the leading variable for buyers' desired return on investment is franchise, of course. And this is in part determined by the strength, the market share and the stability of the franchise, the trust and the relationship between the OEM and the dealer principal. For example, Toyota. The frequency or scarcity by which these franchises become available for purchase, the ease or difficulty of operating the business, even their current challenges or initiatives, i.e. vehicle lineup, electrification, facility demands, minority programs, direct-to-consumer ambitions. We're seeing some manufacturers that were pushing that over the years. Or the size of the dealer network as it relates to its throughput. Everything matters. And again, while this is similar to the concept of a multiple of earnings, we believe it should be a multiple of a buyer's pro forma, specifically the return on investment for the goodwill portion. This considers variables that may influence future earnings, like sales effectiveness, image compliance versus required CapEx. We just consummated the sale of a large Chevrolet dealership in Texas. Our process brought a 10x multiple. Does that mean Chevrolet brings a 10x multiple? Or even that the purchaser was comfortable with a 10% return on investment for a Chevrolet dealership? Of course not. The purchaser saw a path to increase the performance and was very comfortable with the risk-reward profile. In Lithia's last quarterly report, they were quoted, "We evaluate potential capital investments primarily based on targeted rates of return." They don't mention anything about past performance. So for the luxury brands, buyers are willing to accept as little as a 10% return on the goodwill portion for many of the reasons that we mentioned above or prior. With Toyota's focus on throughput, their interpretation of the partnership between dealer principal and the manufacturer, their discipline in manufacturing or production, Toyota has risen to a tier of its own. We often find that the values of a Toyota dealership stand tall or sometimes even exceed that of a luxury dealership. Audi, Jaguar Land Rover, Honda, and Subaru have taken a step back. Yet with the exception of a standalone Jaguar dealership, these franchises remain in very high demand. A few years ago, we set the record for the highest goodwill ever paid for a Subaru dealership, and it still holds today. Now, the next category may appear to be a bit controversial. There is simply no difference between a Chevrolet, Buick, GMC, Cadillac, Ford, Hyundai, Kia, Mazda, unless you pair it with the market in which it operates. A Chevrolet dealership in a truck market could command a higher value, a higher multiple, a lower ROI than a Korean import in the same market. We take it to a metro market and it could be exactly the opposite. And that's why these brands are sitting in a tier together in a bucket that are driven by market. Buyers are typically looking for a 20 to 30% return. And it's as much dependent on the market in which the brand operates as it is the brand on its own. For the boutique, lower volume luxury brands, while buyers seek a similar return on investment as those market-driven brands above, we tend to find that there's a ceiling on what they're willing to invest just given the lower volume and the additional benefits like reinsurance, for example, that comes with higher volume versus lower volume dealerships. And lastly, when buyers factor the risk-reward profile, the risks associated with those challenged or other, we call them brands, they're simply looking for a greater return. And that range can fluctuate drastically. But franchise is just one ROI driving factor. We've touched on this. So many variables play a role in buyers' desired or required return on investment. Consider the market. Is it growing or contracting? How's the access to good talent? Is it a destination location for consumers, or is it on the mile of cars in San Diego? State taxation and business-friendly climates are always a major factor. Image compliance versus CapEx are always a point of discussion, plus the overall value of the real estate and the affordability by the business. The performance, is there upside potential or is it 125% sales effective and you can probably only really go down? How do the KPIs compare to that of the industry standards? How's the competition in your immediate market area or your contiguous dealers of the facing brand? Even management, reputation, culture, history, they play a vital role. Again, everything matters. So as we conclude the valuation section, I like to share a Venn diagram that I think speaks to the art of value. On one hand, we have the earnings versus projections. On the other side, we have the return on investment. At the bottom, we have the risk versus the reward. We have the upside opportunity versus the uplift required to monetize on it. At the top, we have the unique motivation between the purchaser and the seller. And somewhere in the middle where everything intersects, we find the value. So, what is our outlook for 2026? Well, unless it's this guy, I am always wary of anyone who professes to have a crystal ball. We've seen too much volatility over the last 5 years. Nonetheless, can't imagine you let Jimmy and I out of here, although I think Jimmy's going to be on this stage for the next 2 days, but without at least offering you our intuition. Evaluating the market dynamics, looking at our current pace of activity and valuations, and of course, barring an unforeseen setback, values and activity should remain very strong. There is simply no indication to suggest otherwise. Buyers are still cash flush. They're looking for opportunities. They enjoy the benefits of scale and synergy. Unfortunately, there are way more brokers today than I have ever seen who are hustling deals and spurring buy-sell activity, which is a good thing. The retail business continues to pose challenges, enticing dealers to consider an exit. It's increasingly more difficult to compete against larger groups for margin compression, reduced SG&A expense, even competing for personnel where they may offer employment opportunities to grow within a larger organization. The facility demands by manufacturers are in fact never ending by the sheer nature of it, especially with the introduction of EV infrastructure. The threat to the traditional retail model and market share by Tesla, Lucid, Rivian, Scout Motors, albeit weak at the moment, but long term, it's real. Most recently, Carvana is entering the new franchise space. You guys hear about that? Welcome to the big leagues, all right? And Amazon announced a partnership with Hertz to sell their rental fleet. But these challenges are nothing new. They just shape shift every few years. And as we all know and respect about our dealer body, they're an entrepreneurial group. They are as resilient as they come. So if you're still having fun, if you have a succession plan in place, stay in the fight. But otherwise, valuations are well above pre-pandemic levels. There are more buyers looking to purchase and always a limited supply of sellers considering an exit. All right, after 30 years of brokering automotive dealership sales, I wish we could say we have seen it all, but every year presents new challenges. The automotive industry historically experienced a return on sales of 1.5 to 2.5% net. COVID was 4 to 6%. And while the market has generally accepted that COVID was a once-in-a-lifetime event, we're still finding many sellers factoring COVID earnings into their valuations. CPAs and accountants, granted, are wise enough to recognize that we have to apply weighted averages, but still, like you all, we spent the last few years trying to determine how much weight to apply to those COVID earnings. And even we applied a minimal weight, it skewed our valuations too heavily. We were going back as far as 2018 to better understand the margins, really 7 years back in evaluation. Fortunately, as we reviewed earlier, it appears the industry may finally be settling at a new normal. Return on sales, in my prediction, could be approximately 2 to 3.5% going forward, which would be terrific. And with 2024 and 2025 showing much consistency, both from a departmental level and from a profitability, we believe that next year we will be able to apply a 2-year look back and use prior years for context only. This should help bridge the gap between buyers and sellers' pricing expectations. Occupancy expense, it has to pencil. Way too often we find that the relationship between real estate values and goodwill are entirely overlooked. Historically, we believe in the KPI, that the key performance indicator, that rent should be approximately 10% of gross profit. And naturally, this threshold fluctuates between metro markets where real estate is more expensive versus rural markets. So while real estate values for automotive dealerships were rapidly appreciating in recent years, most recently, we're seeing some of the national appraisal firms lowering their valuations on real estate, sometimes applying more weight to the income approach, recognizing that the value of the real estate at times was impacting the affordability by the business, or at least stepping well outside of the KPI threshold. So when evaluating facility upgrades, either for a seller or for the purchaser, consider how well the business will be able to support the occupancy expense when finished. There are elevated costs for construction and furnishings, higher interest rates for construction loans and remodeling, or for the mortgage for the purchaser, and potentially even a decline in performance during the 18 to 24 months during remodeling. Now, we definitely support and encourage imaging the facility for the proven benefits to the dealer and because buyers do prefer image-compliant facilities. But if seriously considering a sale in the immediate future, leave the remodeling to the buyer. Yes, the buyer will factor the remodeling expense and the hassle into their valuations, but not dollar for dollar. They're also going to most likely be able to negotiate a grace period with the manufacturer, further reducing their requirement for a discount. So as always, continue to be mindful about the relationship between real estate values and goodwill, as well as understanding that the value of the real estate needs to be an amount that the business can support. Now, when we engage in opportunity for sale, we immediately consider the initiatives and the objectives of the OEM. After all, they are the ultimate decision maker. We've seen a rise in the prevalence of the right of first refusal, an incredibly powerful tool that allows them to shape the dealer network in their image. The importance of minority initiatives vary by manufacturers, and their programs are updated regularly. There's a particular manufacturer right now that's emphasizing the concept of pods, building pods where one dealer will control multiple contiguous markets. So understanding the overarching objectives by the OEM, understanding their minority programs, the importance and value of scorecards, what they're looking for in a candidate is critically important to increase the likelihood of a successful transaction. Earlier this year, I was at Toyota headquarters just to meet with the representatives and learn more about what Toyota is looking for in a candidate. With the challenges surrounding certain brands like Stellantis, for example, we've seen first-time buyers engage in opportunities to acquire these distressed businesses, despite having the approval from the manufacturer to operate as a Stellantis dealer, having the approval by the lender to finance the acquisition. They're struggling to obtain floor plan approval, even from the captive. Some floor plan lenders are requiring hundreds of thousands of dollars in a reserve account unencumbered. Some buyers are looking to alternative floor plans with higher, aggressively high interest rates. Both are adding friction to these types of transactions. In recent years, we were involved in many SBA-backed loans, sometimes with as little as 10% down. But that segment of the market has contracted, with some of these challenged dealerships now actually losing money, making it more difficult to obtain both financing and a floor plan. And ladies and gentlemen, as we all know, together in this room, we are involved in life-changing moments, life-changing events for our clients, whether it be an aging dealer with no succession plan in place, looking to us for guidance on their retirement, or a family-owned business with plans to expand and create new opportunities for their families, for their employees, for their communities. We all know that the buy-sell process can be overwhelming and emotional. The stages of negotiations and due diligence are every bit of 6 months and potentially significantly longer depending on the complexities of the transaction. Meanwhile, our clients are coping with the reality of selling the family business, a symbol that reflects decades of risk and exposure, sacrifice, sometimes even pain, a business where their identities are often intertwined. So while acquisitions or divestitures are purely a transactional relationship for some, we like to remember that there are people behind these dealerships. There are emotions behind these transactions. There are legacies that warrant preservation and family histories that need to be told. But let's not forget about the buyers either. Sometimes the buyers are putting everything on the line, assuming debt that most of us in this room probably would never even consider, uprooting and relocating their families, taking a bet on the seller as well, that the business was in fact as it was represented. So while some may casually toss around the phrase, it's just business, that's never been true in the car business. Let's bring emotions back into these transactions because people like to do business with people that they like. And when we can connect the principles on a human level, when we can introduce a mutual respect for one another, and that goes for their professional advisors as well, the buy-sell advisors, their legal and accounting, respecting both sides of the transaction, we significantly increase the likelihood of ironing out the inevitable issues that are certain to arise. In the roles that we all play for our clients, these are high stakes. In my world, it's all or nothing. Either the deal happens or it doesn't. So I live every day with the philosophy that everything matters. So I'll leave you all with a quote today that has always resonated with me. Henry Ford said, "A handful of men have become very successful by paying attention to the details that most others ignored." Thank you, ladies and gentlemen. We have a couple minutes for Q&A. Jimmy, you are taking the first question.
Well, yeah, we do have 2 minutes, so thank you, Jesse.
Or we can let everybody out early.
Well, we can do that too. We have 2 questions. And Jesse, I'm going to pitch them to you.
Give me a breather, at least.
You're the expert. In determining enterprise value, do you include floor plan debt? And do you add back floor plan interest if calculating EBITDA?
Absolutely not. We get that question often, and especially from the general realm of accounting outside automotive. EBITDA is interest other than flooring. Only floor plan interest expense is a necessary expense. In fact, I'll go one further to illustrate the point. If you are self-flooring your inventory, which we don't see often, but we do see at times, it is actually a negative adjustment to your earnings because you need to normalize and recast the earnings to reflect a normal operation. To what extent do we go? Do we normalize advertising expense as a percentage of gross profit or payroll expense? Perhaps to an extent, but something as glaring as floor plan interest expense, if you're self-flooring your inventory, it would be penalized in the eyes of a buyer because every buyer for the most part is going to have a floor plan interest expense.
Okay. And the last question, what impact will tariffs have on the valuation approach? How do you normalize those?
That's a great question, and I must say, so far we have not seen an impact. While certain manufacturers perhaps may have more exposure to tariffs, we haven't seen it yet. As I mentioned earlier, the manufacturers have absorbed the brunt of it. It's going to change. It's going to get passed on. I assume it's going to change. It has to. passed on to the dealers, passed on to the consumers, but we have not seen an impact yet, and certainly not in valuations or in levels of buy-sell activity.
Okay. With that, I'd like to thank Jesse from Performance Brokerage Services for sharing his thoughts.
Thank you, Jimmy.